A very good evening to everybody. I welcome you all to this intensive course on accounting standards, the virtual course that WRC has launched. I think from a practice point of view or a knowledge point of view, it's a very important course where we need to constantly refresh ourselves. And so that's why we have designed a course which is structured into several parts. Today being the first part based on applicability and presentation issues related where all the standards where disclosures and applicability presentation standards are being covered, and I hope all of you have a very enriching experience. Before we go forward, I would like to everybody to come to attention for the ICI motto. Mishra ji, can we have the ICI motto, please?
Yaesha supteshu jagrati Yaesha supteshu jagrati Kamam 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 Purusho nirmimanaha Tadeva shukram Tada Brahma Tadevamritamuchyate Tasmin lokaha shitaha Sarve tadunatyati kaschan Etadvaita
Thank you. See, these days, all of us are always talking about Ind AS, IFRS, etc. And somewhere the importance of accounting standards seems to have gone down. Not rightly so, because even today, almost I think 80 to 90% of the entities, it's the accounting standards which are applicable, whether corporate or non-corporate SSC. And that is why at WRC we thought that we should bring this back to the fore and maybe refresh everybody's knowledge on accounting standards. And that's why this intensive course on accounting standards. So without any further remarks from my side, I will now request WRC Chairman CA Murtuza Kachwala to kindly give his opening remarks. Murtuza bhai.
Thank you, Rahul bhai. A very warm good afternoon to all the participants. Let me first thank CA Prashant Daftary for agreeing to be as one of the faculty here today and decide to share his knowledge with all the participants. Prashant, thank you very much. We are extremely grateful.
Thank you, sir.
Let me also thank CA Charmi Shah, the coordinator for today, and for supporting WIRC throughout. Thank you, Charmi. Let me also congratulate Rahul for such a beautifully designed program. And I think we finished last month a refresher course on Ind AS, and we had 200+ participants and really encouraging feedback. So congratulations, Rahul bhai, for all the good work that you are doing. Rahul is also handling he is the chairman for Internoid committee, and about a month back we also did one national conference on Internoid with 500+ participants and 180 people physically attending. And if you see throughout on social media, tremendous feedback and really excellent faculties and good sharing of knowledge. So good work which is being done. Now again on the accounting standard and post the accounting standard, in fact Rahul and the Ind AS committee is also planning one on the international gaps, because there are so many large shared service centers of large multinational companies in India, be it Pune, Ahmedabad or Bangalore, Chennai, Hyderabad. where people are like doing accounting for UK, South Africa, and other countries sitting here in India, even US. So we'll also cover the international gaps, different forms, again in a refresher course. So at WIRC, like the theme this year is leap towards excellence, achievement, and development. And we have listed down 5 goals. And against the goals, various activities and measurable criteria that we want to achieve. But if I were to touch upon 2 important goals, one is on updating the members technically. So like be it direct tax, be it indirect tax, we are starting with the direct tax refresher course, which is one of the signature event on this Saturday 18th. So on all the technical subjects also, we want to ensure that members are updated and the knowledge is like up to date. And we are also organizing lots of programs on technology, be it a short 3 hours, 6 hours also, but we are also planning longer duration. And one which I would want to touch upon is a course on data analytics, where we are teaching hands-on Python querying and SQL database. And this is on Saturday evening, Sunday morning, 60 hours for as low a fee as 9,000 rupees. And part 2 is visualization, Power BI and Tableau, where like all the data can be presented in a beautiful form. And that is again a 40 hours hands-on sitting at home, but data really on taking the TDA, GST, and relevant data which can be used by us. So lot of action happening. I request everyone to take maximum advantage of it. Join whatever courses and technical subjects you would like, and keep updating yourself. With that, I think happy learning, and a big thank you to everyone for joining this certificate course, this refresher course. Thank you. Over to you, Rahul bhai.
Thank you, sir. Thank you for the encouraging words. Now I would like to introduce our today's faculty, CA Prashant Daftary. CA Prashant Daftary is a partner with NA Shah Associates LLP. He has more than 15 years of experience in audit and assurance services. His areas of specialization include IFRS, Ind AS, statutory audit, process reviews, due diligence reviews, and risk-based internal audit. He has made various presentations to study circles, branches, and at WRC on accounting standards, Ind AS, internal audit, due diligence, etc. He is also a contributor of articles to various journals published by CPC, ET, CFO, ET, and other online platforms. And with these few words, I would like to welcome our today's faculty, CA Prashant Daftary. Prashant, we welcome and thank you very much for accepting our invitation and being a part of this very important course that I believe it's something that will benefit the members. It would go a long way. Welcome to Charmi Shah, also our coordinator, who shall be with us through this program. Welcome, Charmi. Over to you, Prashant bhai. Please, I would request you to start your presentation. Thank you.
Yes. Yeah. Screen. Is the screen visible, Charmi? Is the screen visible?
Yes, sir.
Yeah.
Yes, sir. Yes, sir.
Thank you to the WRC team, Murtuza sir, Rahul, for having me on the session on this refresher course. And as it is rightly said, that though there is an Ind AS, there is IFRS, but the Indian gap which is there, and it still remains a backbone, because what is very important is that even if you want to learn Ind AS, the knowledge about the Indian accounting standards is very important, the regular IGAP, because it is, once you have the fundamentals of that very clear, the Ind AS is the next ladder upwards. So this becomes very important, and more than 70 to 80% of the entities are still under the Indian gap, where it becomes extremely relevant. So this is a very good initiative from the WIRC, and happy to be sharing my knowledge with you. Obviously, the theoretical aspects are there, but at every point of time I will try and touch upon my personal experience on various aspects. And in case there are any questions, do put it up on the chat box. We can take it at the end, or in case something it is very urgent, Char, we can intervene and we can speak at that point of time also. So that is not an issue. Yeah, so we will start the program today. So basically what we are going to cover today is on the applicability of the accounting standards and the framework, the accounting standards applicability for non-corporate entities, the recommended financial statement format for non-corporate entities. This is a very recent guidance note which has come few days back. So I have tried to cover that part also, and I think that should be little helpful because it is the newer part of it. And the 4 accounting standards which have been allotted to me: AS1, AS3, AS4, and AS5. These are all very basic standards, but they form a heart of the financial statements. Some of these are the standards where either maximum number of mistakes are also getting observed during the FRRB review or the QRB reviews, and hence this becomes very important. At least AS1, AS3, and AS5 also to a certain extent, because these are very critical. And from a mere review of the balance sheet, if there is something wrong in this, that can be very easily picked up, and hence that becomes very important from the auditor's perspective as well as the preparer of the financial statements perspective. There is a framework for preparation and presentation of the financial statements, and this is like the framework under which all the accounting standards are getting formulated. It defines the key elements of the financial statements. So a lot of times, if we need definitions of assets, expenses, liabilities, provision, this is the statement that we can refer to. It defines what are the expectation of the users, the measurement elements of various financial statements. It lays down the broad principles for formation of the accounting standards and the qualitative characteristics, which is relevance, reliability, comparability, and understandability. So this is something, these are the base or the certain fundamental principles which any preparer of the financial statements or even accounting standard preparers keep in mind while the accounting standard are formulated. And whenever there are any doubts in respect to the interpretation of the terms of the accounting standard, I think this framework comes in very handy. So this is like a parent or the umbrella standard which is there, and it obviously helps in interpreting various terms which I've already mentioned about earlier. So that is something which we should refer to and keep in mind if there is any doubt about the interpretation of various accounting standards. So for example, a lot of times there are practical questions in respect of whether this is a liability or a provision, and what is the distinction between a liability and a provision. Here the terms are very clearly defined, and this will help you in making the right judgment or the right segregation or the classification in the financial statements. As far as the applicability of the accounting standards goes, from a Companies Act perspective, there are 2 criteria: the SMC companies and the non-SMC companies. So the non-SMC companies are companies who are not listed or are not in the process of listing, not a bank, financial institution, or an insurance company, and whose turnover does not exceed 50 crore or does not have borrowings in excess of 10 crores at any time during immediately preceding financial year. So these are the criteria which are raised, and it is not a holding in a subsidiary company, which is not a SMC company. So these are some of the criteria which are there. So when you look at the applicability of accounting standard, you have the first the flowchart begins with whether it is a corporate or a non-corporate. Within corporate, you go to Companies Act, and then you analyze the sections in terms of applicability of the accounting standards. In Companies Act, there is one more element which needs to be factored in, which is whether the company is a small company as defined under Companies Act. If it is a small company, then cash flow becomes applicable. When you go to the next slide, you will see that there is an exemption to cash flow. But by section 129 and the definition of a small company, so section 129 and 240 to main section 2 subsection 40, where this small company is defined, you will it will be very clear that cash flow is applicable to even a small company. It is not applicable to OPC, small company, and a dormant company. So you could be an SMC company, but still not be a small company. So that is one distinction that we have to take care of. Because these are some of the we have seen cases where either sometimes by misinterpretation or sometimes the cash flows are not prepared, or some of the standards are not properly applied in the financial statements, and there is certain care which needs to be taken when you are taking exemptions which are available to a small company. We will come to those slides later on. So these are some of the standards which are not applicable. AS3 is not applicable subject to the small company definition, and if you do not fit into the small company definition, it is applicable. AS17 is not applicable in terms of segment reporting, and some of the accounting standards which are not applicable since the relevant regulation complies only by non-SMC like consolidated financial statements. Obviously, once your consolidated is not there, your investment in joint ventures, associate, similar standards do not apply to you. There are certain relaxations which are given from disclosure requirements, or few cases the measurement is made simpler. So AS15, there are certain relaxations which are there for a small company. Normally it is defined as companies with less than 50 employees, where there are certain relaxations which are given in terms of the leave encashment benefits, valuation of that undiscounted value can be taken, or short-term and non-vesting accumulated benefits. There are certain measurement exemptions which are there. Impairment of assets, the value in use, there is certain exemption which is there. The objective is to make it very, very simple, and the effort may not be there. So a lot of complex formulas and the complex calculations which are required for impairment testing, some of them are relaxed, and you need to do it in a slightly more simplistic manner. Similarly, in provision contingent liabilities and contingent assets, there are disclosure exemptions which are there, and interim financial reporting also there are certain exemptions. Once we are clear about whether it is a corporate, non-corporate, and corporate part we have seen, now we see the non-corporate part. For the non-corporate part, you have to go as per the ICAI requirements. ICAI has segregated in 4 categories. Earlier there were 3 categories, and now the 4th has been added very recently, maybe 6-8 months back. Large entities, medium-sized entities, small entities, and micro, small, and medium entities. That is the 4th criteria which is there. The next slides we will see the definition of each of these which are being given, and the applicability of the standards. So this is something which is a starting point when you are looking at even the non-corporate part of it. Some of the important things that we need to take care when the exemptions are getting availed are that, if you are availing any exemptions, you need to give the disclosure in the accounting policy that you are a small company or you are level 2, level 3 companies, and accordingly you have availed the disclosure requirements as per ICAI or as per the Companies Act notifications. So that is one part of it, that you need to make a disclosure and emphatic statement. In case a company no longer qualifies for exemption because its size has increased, and from during the year the turnover has increased, but last year it was a level 2 and then it shifts to level 1, then from the year it will shifts, you apply the new standards which are applicable to you, or the new disclosure requirements which are applicable to you. The previous year figures do not restated, and this fact also needs to be disclosed that the company has moved from level 2 to level 1 or level 3 to level 2, and accordingly the newer disclosure requirements have been made during the year. Sometimes it is also possible to avail partial exemptions unless it is becoming misleading to the relevant users. Partial disclosures can also be availed. And there is another question which comes in: if the company was an SMC, not an SMC earlier, and it becomes an SMC in the next year, there is a transition provision which says that you need to be a non-SMC for 2 consecutive years, sorry, an SMC for 2 consecutive accounting years, so that before you transit into the lower level of the disclosure requirements. So an SMC, non-SMC company has to wait for 2 years before it can apply the SMC disclosures after it has met the threshold limit. So these are some of the important points that we need to take care about. On the criteria which are there as per ICAI, these are very, very broadly similar to what the Companies Act defines. The limits are different. So basically the turnover who is exceeding 250 crore or borrowing in excess of 50 crore are level 1 entities, and other criteria are similar to the corporates which are in the listing and the banking, financial institution, insurance business, or holding in subsidiary company of other entities. For level 2 entities, it is between 50 and 250, borrowing between 10 and 50, and it should not be a holding in a subsidiary company. So this is the level 2 which is there. Level 3, it is between 10 and 50, and borrowings are between 2 and 10. And whatever is not level 1, level 2 is level 4. So these are the broad criteria which are there. Next 2 or 3 slides, what I have done is a quick snapshot of what are the accounting standards which are applicable, what are not applicable, or what are applicable with exemptions. So this is something which can be referred to. I have tried to summarize it in 2 or 3 slides. If you see, AS1 is applicable to all because it is the parent or the accounting standard where the disclosure of accounting policies are there. Inventory valuation is applicable to all. Cash flow is applicable only at level 1 level. The other 3 levels cash flow is not applicable. AS4, AS5 are applicable. AS7, AS9, AS10, they are all applicable. AS10, property plant equipment, this standard is very similar to the Ind AS standard. There are a lot of exemptions in terms of disclosures which are available for the level 3 and the level 4 entities with respect to property plant equipment. Foreign exchange transactions, there are certain exemptions which are available. Disclosure exemptions for level 3 and level 4. Government grant is applicable to all. Investment, only level 4 there are certain disclosure exemptions. Amalgamations, except level 4 it is applicable. Employee benefits, there are a lot of exemptions which are available, or disclosure exemptions are there, or certain other exemptions which I said earlier in terms of the leave benefits, the actual valuation part of it. Borrowing cost is applicable to everyone. Related party disclosures, level 3 and level 4 it is not applicable. That is a quite a significant exemption which is there, because a lot of time and efforts could be saved there. EPS, generally in a non-corporate mostly would not be applicable unless there are exceptional situations. Discontinued operations, there are exemptions. Consolidation, there are exemptions. Income tax, there are applicability, but it depends whether it is a cash base of accounting or a accrual base of accounting. So in terms of the deferred tax, there could be certain changes. Interim financial reporting, there are exemptions. Intangible assets, there are certain exemptions for level 4. JV, as I said, it is similarly on the lines of consolidation. Contingent AS29, there are certain exemptions, and even in impairment of assets, there are a lot of exemptions. This is the non-corporate, and then another important area which comes in, that what happens if it is a non-profit organization, because that is another challenge that we face, that when we are finalizing the accounts of non-corporate and also especially not-for-profit organization, there are a lot of questions which come around. There is a technical guide which has been issued by the Institute on Accounting for NPOs, which is quite useful in terms of the principles which should be adopted. Another question which comes is, on the applicability of the accounting standards per se. There is a view which is said that accounting standard is applicable only if you are doing a business or a commercial operations, and the NGOs are not doing commercial operations, and hence it would not be applicable. But it is recommendatory that the accounting standards are applied to the extent possible. That is what is the recommendation from the institute. Disclosures and the presentation principles would depend on the nature and the type of the NPOs. There could be questions on cash basis of accounting and the accrual system of accounting. Certain trust or NPOs may follow accrual basis and certain trust may follow cash basis. So depending on that, you will have a lot of applicability issues in terms of the accounting standards. So this is the broad overview on the applicability and the framework which is there. On the recent guide which has come, on the guidance note which has come on the financial statement on the non-corporate entities, is the next section that I would like to cover. Up to here, are there any major questions or any queries which we need to address, or we can move forward? Chairman, you have received anything on the chat box?
Not yet, sir.
Not yet, no? Okay. So on the non-corporate side, we have seen companies, but the non-corporate side, it could be sole proprietorship firms, HUF, partnership firms, EOPs, societies, trust. So there could be very, very large variety of organizations, and most of them have a very, very different or a unique governing structure. So a partnership firm is governed by the partnership deed and the partnership act. Sole proprietary firms, there may not be any law, but the accounting statements may be audited for the purposes of tax audit under 44AB, or it may be required for bank loans or any other purposes. EOP, again, it is more from an income tax perspective, the accounts are prepared, or unless it is a part of a larger corporate group where it is required for consolidation or any other purposes. Trust and societies, there are separate laws which govern them, and based on the requirement of those laws, the financial statements are getting prepared. In case of a trust, a private trust, I have seen cases where there was a question which was asked that, why accounting standard should be complied by a private trust. It was a family trust. So that question was being deliberated, and when we have a look at the trust deed, one of the clause of the trust deed was the accounts are to be prepared in compliance with the accounting standards. If the trust deed requires that accounting standards have to be followed, you have no choice but not to follow, because then it becomes the responsibilities and the obligation of the trustee to follow the accounting standard. So some of the times the answers to the questions are also there in the charter documents or the governing documents of the respective entities, and that has to be looked at very, very carefully. Here the issue was that the related party disclosures were not made, and the qualification had to be given for that, and why the qualification should be given was the matter of debate. So that is the practical example which was there, which I was trying to highlight in case of a private trust, because obviously there were certain apprehensions in terms of whether we should disclose it. If it is not mandatory, why do we disclose? Because from an income tax perspective or for any other perspective, those questions or apprehensions were raised by the client. So we had to convince them that since it is required by your own trust deed, there is no option but not to give, and if, in case you do not give, then obviously there will be a note in the audit report or a qualification in the audit report which will have to be given. Similarly, for sole proprietorship firms or even partnership firms, there are a lot of questions which come about, whether previous year figures should be given or not, whether it is mandatory to give previous year figures, what should be the format, should I do current, should I do non-current, which is similar to company, or I can do, or I have a flexibility, because there is no law which prescribes any format. And obviously in that case, both the views may be possible, but a more better view would be to do current, non-current, depending on the size of the partnership firm. Because if it is a large partnership firm with a huge turnover and large bank borrowings, you would like to look at the governing structure or the corporate governance, which is very similar to a large corporate entity, though it may be under a partnership format. So that becomes very, very critical. But the charter documents and the governing law, those are the two very, very important items which should be looked at. The guidance note which are there, some of the key features which are there is that it prescribes consistency now. It has given a proper format, current year figure, previous year figures, accounting policies, notes, a proper format has been prescribed. Generally, they have used the principles of the companies which are there in terms of the presentation or the preparation. This is not obviously a mandatory which is coming through a law, but if the institute has come out through a guidance note, so it will become the duty of the members to try and comply it to the extent of possible. Illustrative format has been prescribed. Disclosures which are there in the guidance are in addition to the requirement of accounting standards. Each item of the balance sheet P&L has to be cross-referenced with the corresponding notes. So this is another suggestion which is coming out from the guidance note. Corresponding figures and comparative figures to be provided. That is the suggestion which is there. In practical real life, I have seen practices which have been contrary, or a lot of inconsistent practices which have been followed, especially in the non-corporate arena. If a specific format is prescribed by law, it should be followed. So if there are certain formats for societies or educational institutions or a trust under any other law, those have to be followed. And suitable notes will have to be inserted where cash base of accounting is followed. So for example, in case of a cash base of accounting, revenue recognition would be differently done, because it is whatever cash is received becomes revenue and the accrual concept is not followed. There may not be any debtors, or there may be some specific cases where certain hybrid accounting may have happened in terms of items like tax provision or a statutory liability which may get created. Sometimes there are inconsistent views which happen, or like items like even advances for purchase of fixed assets, whether it is to be capitalized or whether it can be shown as an advance because the asset has not received, and the depreciation may not be there because asset is not put to use. So those type of questions do come out, and hence they have to be addressed by way of suitable notes. Another typical issue which happens in a non-corporate is on the depreciation, where the depreciation is generally done because of the income tax rates. Now, when you provide as per income tax rates, you are indirectly not complying with the accounting standard 10 on property, plant, equipment, because it says that it has to be over useful life. Now, whether the useful life which is estimated and the rate of depreciations under income tax coincide, which is a or they do not coincide with it, is a matter which has to be done on a case-to-case basis. Either ways, you will have to give a suitable note or an explanation in that matter. So those are some of the peculiar issues which come out while you do a non-corporate entity and you want to look at the compliances from the various accounting standards perspective. And understand that the client may not be very interested in terms of that theoretical compliances, whether they are happening, not happening, and they are looking at the timely completion or the cost during which it is within which it is completed, or it is mainly for income tax purposes, so that really they are not bothered. But from the governance or the institute compliance perspective, these all items become important. And if you have list of such items or standard format which has to be followed, it becomes easier and less time consuming, and obviously the level of accounts can be upgraded. Another key features, continuing with the same thing, they have used the term owner's fund or owner's capital account is the terminology which is used. Separate note or a schedule should be there for each of the owner in terms of what is the withdrawals, what is the further infusion of capital, any other adjustments to the capital account, distribution of profits, and other items. Current and non-current is suggested to be done. That is something which is very important, and it's a large change if it has to be implemented. So this could be something big in terms of implementation. Once you do that, your operating cycle has to be disclosed in the notes. Disclosures of guarantees provided by owners, partners, and proprietors should be given. That is another one area where if in the past such disclosures have not been made, they should be made. MSME disclosure is something which is mandatory for all the companies. It is not only required for companies. That has to be made. Even the note which was to be given, because it is coming from a separate act, it had to be given. Not of partnership firms, they were not giving that. So that is something which the institute has come out to bring about consistency. Disclosure of contingent liabilities. Here also there have been inconsistencies in terms of certain people mentioning, some people not mentioning, because there was no law corresponding to that. So technically AS 29 did apply if based on the level 1, level 2, level 3 criteria, but this now becomes a reiteration of what is the requirements and all the notes which are to be there in a standard set for a non-corporate entity. So this is one new development and a very good guidance which has come out from the institute, which will at least help the preparers and the auditors to at least bring some level of consistency on the preparation of the accounts and the audit of the accounts of non-corporate entities. So that is on the framework, applicability, and the financial statements of the non-corporate entities. That is the broad overview on those areas. Now we will move on to the 4 accounting standards which have to be covered as a part of the overview of the refresher course. And obviously these are the 4 accounting standards which are the base of any financial statements, and each one of us has been doing it for many number of years. So this is an opportunity where we refresh this, and while even reading these 4 standards while preparing the presentation, also I realized some of the things which maybe it has gone at the back burner of my head also, but refreshing that was also an enriching experience, because some of the things which maybe I was missing out or not on top of my mind, the reading of this has helped me. And maybe I will be able to hopefully share some of the experiences in all the 4 accounting standards, so that it can be the subject which can be elaborated or useful to the audience at large. These are the fundamental accounting assumptions we all know about, and the disclosure is required in the financial statement only if these assumptions are not followed. The importance of this is that though we all know and understand this, but as you would be aware, going concern is the most debated topic today, and the expectations of the government, the stakeholders on going concern is something which is going up on a daily basis. Most of the cases where the issues relating to going concern have come up, either the companies, accountants, auditors, they have been questioned very seriously in terms of how the going concern assumption was validated and what care was taken on this area. So going concern becomes very, very important. The new CARO also has a line on going concern which is there, reporting on going concern which is there based on the ratios and other things. That a quantity would be a going concern, so that reporting is there. There is a separate auditing standard on going concern, and hence this becomes very, very important. What is the basis on which the going concern is there? Consistency and accrual also very critical and sometimes gets missed out. And this happens because in a hurry to complete the accounts, we sometimes do not look at the consistency angle. So some of the examples could be that if during the year if there is a major acquisition of another company, or you have sold certain assets, large assets impacting the revenues, or certain divisions have been sold, or the accounts are for a part period and the previous year accounts are for the full period, the note that accounts are not comparable is something very important. This comes from the fact of consistency and comparability. There could be changes in accounting policies, accounting estimates, whether we are bringing it out in a proper manner or not in a proper manner impacts how the accounting numbers can be interpreted or they can be looked at. So for example, it could be a large change in the provisioning of debtors, or it could be new provisioning norms which have been implemented in the current year, which are not there in the previous year. So obviously there is no consistency, and hence they have to be properly disclosed. And yes, other accounting standards would talk about it in more detail, but this is a fundamental thing that we need to keep in mind. What are the changes as compared to last year, and whether they are account of business transactions or any method of recording those transactions, we need to be very clear about it. Accrual is a concept which is there all throughout. It is there in all the accounting standards which when we do the measurement. So be it employee benefits, be it your deferred tax, be it revenue recognition, accrual is running all through. Sometimes it could be a matter of challenge or a matter of debate. What is the accrual, at what point of time accrual is there? And hence we need to keep in mind that any new transaction or any new event which has happened during the year, how is the accrual concept being followed, not followed, in case there are new contracts, new agreements, some complex transactions which are there, you have to be careful. And one area where the accrual concept is sometimes missed out is commission expenses, where the agreement sometimes says that commission is payable only upon receipt of the money from the end customer, and we do not accrue for either commission income or commission expense depending on which side of the agreement you are on. But it becomes like accrued but not due because you have provided these services. Only thing is that the money has not come, and hence the money is not come to you. A lot of times all those questions come, or sometimes there could be a question is that what happens to the collection effort subsequent to the agreement. So at that point of time, accruals become very critical, and how the agreements are drafted, what is the substance over form, and when should the accrual happen. They are a large matter of debates, and due care should be taken in this area. If we read the QRB and the FRRB, we will understand that more than 5% of the total non-compliances are coming from AS1. Now, there are two reasons for it. One is that when a QRB or FRB happens, they primarily focus on the financial statements review. They look at the accounting policies, look at the requirement of the standards, and there could be drafting issues in the accounting standards, and hence there could be reported as non-compliances, or From there, they are able to identify that the accounting treatment, measurement, or either disclosure is in non-compliance with some of the other accounting standards. So how the accounting policies are drafted, whether they are complete or incomplete, the choice of words plays a tremendous role in terms of the AS1 requirements, compliance with the AS1 requirements, and it does talk about the quality of the financial statements. So whenever due diligence is one of the areas where I also focus on, and whenever there are financial statements which are received for due diligence, you normally look at the quality of the accounting policy which is there, the choice, the language, the completeness, and that gives a good impression about the meticulousness with which the accounts are prepared, or whether the meticulousness with which the accounts are not prepared. And from an external person, it gives a good understanding about the efforts which have gone behind in preparation of the financial statements, and hence it becomes very important. What is an accounting policy? We all know this, but sometimes still in hurry or in terms of finally closing things, errors could happen in terms of either missing out on disclosing accounting policies or confusing between accounting policy and accounting estimate. That is another area where few errors do happen and creep in. Accounting policies refer to a set of specific accounting principles and methods of applying those principles adopted by the enterprise in preparation and presentation of financial statements. So it could be direct method, indirect method in terms of a cash flow, inventories, FIFO, weighted average. So those are some of the things which is a matter of policy choice. And the objective of the institute when the accounting standards are drafted is that there are few choices which are given, so that if the different circumstances are applicable to different people, you follow something which is more appropriate to you. But over a period of time, the number of choices which are given are getting reduced, and the number of options which are available are also getting reduced in terms of the selection of accounting policy, so that more and more consistent accounting happens across industries and across various enterprises. Some of the areas where there are different accounting policies: methods of depreciation, conversion and translation of foreign currency items, valuation of inventories, treatment of goodwill, valuation of investments, treatment of retirement benefits. So it could be whether it is based on actual valuation, whether it is based on without actual valuation, or so those could be few areas which are there depending on the size of the employees or any other methods which are used. Recognition of profit on long-term contracts, valuation of fixed assets, treatment of contingent liability. So the choices which are given under AS 29. This could be few areas where there are different accounting policies which are encountered. As I said, slowly and slowly, the number of choices which are available are getting reduced, and hence they will be expected to have more consistency over a period of time in terms of the choices. Selection of accounting policy: you look at prudence, you look at substance over form, materiality, and the manner of disclosure. These are the broad principles which are there in terms of selection of accounting policies. So what is applicable to your industry? So there could be industry specific choices that you may have to make here. So for example, in a real estate industry, how do you recognize your profit in terms of the development of a project or a residential complex which is there? Or if, so it would depend on whether it is a residential complex, commercial complex, what is the end use, when are the risk and rewards getting transferred. So whether you follow a percentage completion method or you follow a completed contract method, depending on the timing of transfer of risk and rewards, how the corresponding cost are getting allocated. These are areas where the judgment has to be applied. Similarly, under IGAAP, processing fees which are received by banks, NBFCs, there could be a debate in terms of how should that be accounted for, whether they should be accounted upfront, they should be spread over the period of the loan. That is another area where certain judgments are required in terms of when should those be accounted. Those choices are there. The underlying services, underlying cost which are there, manner of cost are the factors which has to be considered, whether it is material or not material. That is another area, and how it is represented to the user. Another area where the accounting policy could be a question mark is in terms of revenue recognition is one area, especially in services, where a lot of understanding of the business is required before you decide on what policy choice you are going to take. So whether it is a continuous service contract, whether it is a contract where the one or two major elements have to be performed in order to say that the work is completed. So for example, it could be an investment banking firm where only once the deal happens you get the revenue. And sometimes what happens, the deal in terms of investment banking, the transactions take 6, 8, 9 months to be completed, and there is a year-end cutoff which is there in between. What do you do? What sort of an accounting policy you adopt in those situations? What happens to the cost up to the date? Whether you can carry forward, you cannot carry forward. In this type of situation, because there is a lack of certainty, you may not carry forward the cost. At least under the Indian standard, you are not allowed to carry forward the cost, unless it is a very, very direct cost and it may not incur if the transaction does not happen. It could be very, very rare. Those costs may not be permitted to be carried forward. So those are areas where, again, the choice of accounting policy, how they are drafted, becomes very important. These are some of the cases where you need to be very careful, especially on the services side. On the goods, you look at the risk and reward, transfer of risk and reward, at what point of time it happens, and in different situation it happens at different point in time. CIF contract, door delivery contracts, X work contract, cash on delivery contract, sale with installation. In all these cases, the risk and reward transfer at different point in time, and your accounting policy will be different. How do you bring out those accounting policies in your financial statements become very important, and they need to be very clearly specified that in the revenue is recognized upon transfer of risk and reward, which coincides upon delivery of the goods. So this could happen in terms of the X work contracts. If you're having a door delivery contract, then you may say that it coincides at the time when the delivery is completed. So those choice of words, those language needs to be there. The fact that it is inclusive of taxes or it is exclusive of taxes, that needs to be very clearly mentioned, because especially in case of non-corporate, there are cases where revenue is recognized including GST. Professional firms, their revenue is recognized including GST. They follow a different method there. So those factors need to be brought out very clearly, that it is net of GST, it is net of discounts. All those matters should be clearly specified in the accounting policies. Another area where details should be properly specified is on the property plant equipment, where what is the useful life which is adopted, whether it is in case it is consonance with Companies Act or in separate useful lives have been followed, and what is the basis, management judgment or report by an expert. Those are the matters which have to be mentioned in the accounting policies. How the useful life is determined, or how the residual value which is there at the end of the useful life is determined, or whether they are reviewed periodically or not. These are the portions which have to be brought out in the accounting policies. Some of the accounting policies which are generally missing is cash flow. What is cash and cash equivalent? Because that is another subject matter of debate. What is a cash and cash equivalent? And there is a separate slide on the cash flow, and hence we will look at it, the cash and cash equivalent related controversies, when we go to the cash flow related matters. EPS, lot of times the accounting policy on EPS is not mentioned. Taxation, deferred tax, MAT, current tax, how it is accounted for, that needs to be very clearly mentioned. So one of the practices which we follow is that you look at each item of the balance sheet and you see whether there is a corresponding accounting policy or not, or whether it is required or not. So if you go by the all heads of the balance sheet and see whether there is a proper policy or a note which is there, and by that method you can look at the completeness of the accounting policies, and that ensures that the comprehensiveness is there. The accounting policy should be disclosed at one common place, and it should not be scattered, so that the reader can understand what are the policies which are being followed. This is one misconception which is there, that if there is a note inserted that that we are doing something which is not correct, then indirectly it can remedy any appropriate accounting treatment. That is a misconception which is there. I have seen many accounts where notes to accounts say that leave encashment is provided on cash basis, or retirement benefit is not provided for. That is part of the accounting policy. That is certainly not the right way to do it. And from that, the question will be there why the accounts are not getting qualified, because this is something which directly highlights non-compliance with accounting standards. So those type of statements should be avoided. It is better that some provisions can be made. If the number of employees are less, you do on cash on non-discounted basis, so arithmetical basis can be followed, or some other methods could be there. Or in case of a large organization, we may have to insist the client that the actual valuation is carried out, or proper accounting treatment is done for that type of items. Changes in accounting policy is another area where we need to be careful. If there are any change of accounting policy during the year, it needs to be properly brought out. So when there is a change in accounting policy, the consistency element also needs to be brought out. So you need to have a statement which says, so normally there is a statement which is there in the accounting policy which says that accounting policies are consistently applied. That statement has to be modified, except in case of a newly adopted accounting policy, or there is a change, or except in respect of change in accounting policy on revenue recognition or inventory valuation, the impact has to be brought out. And if the amount is not ascertainable, you mention that amount is not ascertainable. So that is something which is very, very important, that in case there are any changes in accounting policy, you bring out very clearly the statement. The accounting policy should make it very clear, and the corresponding schedule where this item is getting captured, there should be some cross referencing to ensure that the correct understanding of the numbers is there in terms of the changes in accounting policies. These are rare items because it do not happen every year that we keep on changing the accounting policies, but in the year or in the event it happens, we need to be more careful. Sometimes it is possible that the accounting policy changes do not have an impact in the current financial year, but it may have an impact in the future financial year. So for example, if you are changing the depreciation policy and the assets are acquired in the current year, so it may not have a very large impact for this financial year, but going forward on a continuing basis, it will definitely have an impact, and hence they have to be mentioned or captured correctly. This is very important aspect because it is rare and it is not a day-to-day occurrence. Some of these nitty-gritties or the smaller, finer aspects do get missed out. The QRB and the FRRB, when they review the financial statements, they had certain observations, and I said earlier that more than 5% of their total observations were only on AS1, which is quite a substantial number, considering that this is one of the basic standards which is there and which is there for so many years, and it is a fundamental standard. But still, if more than 5% of errors are happening, it shows that more care needs to be taken to ensure compliance with this standard. Though it is a very simple 3-4 page standard, but some of the matters which are mentioned are very, very fundamental, or to the, it's like a foundation to the entire building. So as I said earlier, non-mentioning of various accounting policies which are there, cash and cash equivalent, taxation, impairment, incomplete wordings, not complete wordings, reference of various laws and regulations, not mentioned. So in case of an NBFC company, we'll have to mention that it is in compliance with RBI law, RBI prudential norms or IRAC norms, or you mentioned that the accounting standards issued by MCA or the section or the notification has to be referenced with. Revenue recognition policies, there are a lot of incorrect drafting where either timing is not mentioned or it appears that cash base of accounting is followed. Sometimes even in the depreciation policies, as I said earlier, those errors were there in terms of the useful lives not being clearly mentioned, or when useful lives are different from Companies Act, on what basis it is different, that is not clearly mentioned, or periodic review paragraph is not clearly mentioned. So those are some of the errors which are happening that needs to be rectified, or care needs to be taken on those aspects. So these are some of the practical tips or considerations which we should keep in mind while the accounting standard 1 compliance is ensured. One of the things that you can do is to prepare a standard document of what is the drafting which should be there for each of the accounting standard. So AS1, AS2, AS3, you go standard by standard, item by item, and what is the accounting policy which should appear. And if you have a standard draft which is to be there, or in this situation this will be my drafting, in this situation this will be my drafting, it really helps in creating consistency, the language, because once that effort is made, you do not need to make that effort every time unless there is a unique transaction. The language should be very clear, understandable. There should be proper cross-referencing. Words has to be very clear and consistent with what is the words that are used in the accounting standards, so that the interpretation can be correctly done. Irrelevant accounting policy should not be disclosed. So there are a lot of cases where MAT is not applicable to the company, but there is an accounting policy on MAT. Or there is intangibles are not applicable to the company because there is no intangible in the financial statement, but you still have an intangible accounting policy. So those things which are there, which should not be there, or sometimes things which are required are not there. So that is something we should be careful. Accounting policies should start immediately as the first note. So you should have the format in terms of the balance sheet, P&L, cash flow. Then you start with the accounting policies, and then you have the further notes. This is the standard format which is generally recommended, and it helps in creating a good flow to the entire financial statement and the document. And the numbering has to be also very consistent in terms of if it is 1, 1.1, 1.2, so that appropriate cross-referencings can happen. This is on AS1, which is a fundamental standard with various accounting policies which are there, and it is a backbone. The real wordings of the accounting standard will emanate from the respective standards which are there. So AS9 will guide what language should be there. AS10 will guide what language should be there for property plant. AS26 will guide you for intangible assets. So all the measurement standards which are there, or the disclosure standards, you will have to go to the respective standards and see what wordings and language should be there. A lot of times people have accounting policies on prior period items, people have accounting policies on exceptional items, people write accounting policies on segmental reporting. These are all items where if they are applicable to you or if they are relevant to you, you should have some of the policies on those cases. But if they are not applicable to you, then you may either eliminate those sometimes. So this is how the accounting policies work. Any questions till now?
Not yet, sir.
Okay, no problem. We'll go to AS3, which is cash flow. Cash flow is another standard which is generally ignored because it is the last thing which is done in the preparation of the financial statements. And generally there is always a rush to finish because a lot of times it is either at the due date, fag end of the audit season, and people understand that this will not impact the numbers, so numbers are not going to change, we can do it later on also, and the other more important task can be completed. So in that sense, a lot of times the relevance, the importance which should be given to this subject matter is sometimes reduced, and as a result of which the number of errors, the compliance is generally weak, and a lot of times there are problems in terms of reconciling the cash flow. Accountants struggle, and ultimately the auditors are required to step in and help. This is a common phenomenon which is experienced across, and I'm sure a lot of the participants who are there would share my experience on this. But it's a very, very interesting accounting standard. If done properly, if read well, interpreted well, it adds a lot of value to your own understanding about how the year has gone by in terms of the cash movement. And that really helps in understanding the business way it has happened. When you talk to promoters and you are able to talk about how the cash flow has moved and your own understanding of the cash flow, it really enhances your value as an auditor, as an accountant, that we not only understand what is the profit and loss, but we are also understanding how the cash has moved, what are the performance from the operational level, where the money is getting stuck, and how the money is generated and where it is getting invested. So those are the three critical areas which are there. When we look at the definitions, the most important one is what is cash on hand and what is cash equivalent. A lot of times there are questions around this area itself. Some of those we will deal with in the subsequent slides. So typically cash and cash equivalent is, obviously cash is there, your fixed deposits are there, you have your cash bank balances. Fixed deposits, you'll have to further dwell into the subject, whether there are liens, whether there are no liens, whether they are available for use. But generally, if it is a normal treasury fixed deposit, it is part of cash and cash equivalent. What do you do about gold? What do you do about liquid mutual funds? Those are some of the areas which are there where the interpretation of the cash and cash equivalent is quite necessary, because there have been questions about whether gold is cash and cash equivalent, because it can be immediately sold off and I will get the value. So those questions are there. Generally, answer is no, because it is more of an investment where it is the value fluctuates and it is not an insignificant risk of change in value. So that are some of the important terms which are there and important items where whether it is a cash and cash equivalent or not, you may have to make decisions. Segregation between operating, investment and financing activities is something which is very, very important. Depending on the nature of business, you will have to segregate that. So for example, interest is generally part of investment or a financing activity, but in terms of NBFC company, interest would become a revenue generating activity and hence it becomes income from operation. So there are some principles when cash flows for NBFC companies are different and cash flows for non-NBFC companies are slightly different. Yeah. Direct versus indirect method. So there is a small correction which is there. It is not indirect versus indirect. It should be direct versus indirect method. 99% of the cases, indirect method of cash flow is used. Direct method is very rarely used. Indirect method is where you start from the net profit, and for the operating activities you adjust the non-cash items, and then you have the movement in debtors, creditors, and current assets, current liabilities to give you the operating activities. And in case of a direct method, you will look at the receipts from the sales, you will look at actual payments to the purchasers. That is a different method. For investment and financing activities, either you follow direct method or you follow indirect method. The result is same, because here all the activities are shown at directly the gross level. So loan taken from bank is taken at a gross level, loan repaid to bank is taken at a gross level, or even investments are done at a gross level. We start with operating activities. These are principal revenue producing activities where you look at the revenue related items, debtors, your current assets, current liabilities, provisions which are there in relation to the business. You have obviously adjust the non-cash items if you are following the indirect method of accounting. The taxation part is there, and you get the cash inflow or cash outflow from operating activities. And once you look at this, it will show you how the cash has moved or cash has not moved. So it would be possible that you are having a good profit, but at the cash flow from operating activities you are looking at a negative number because a lot of money is stuck in the debtors, or large payouts have happened to the creditors, and hence the net cash which is generated from the operating activity is low in spite of a large profit, or you may have a lower profit and you may have a vice versa situation. So understanding how the dynamics are changing from the profit to what are the cash flows becomes very important in understanding the results. So if you're looking at the money getting stuck in debtors, from your auditing procedure or from any other business angle also, you can look at how where the money is stuck, whether they are good, whether they are not good, whether they are old debtors, new debtors. So it can also link you to your debtors area or your understanding which you have obtained during that area, whether that correlates with the analysis of the cash flow could be something which can be very interestingly done. Investment activities, they are usually the acquisition and disposal of long-term assets, investments which are made in subsidiaries, investment in joint ventures, investment in shares for mutual funds for treasury movement or treasury management. Those are certain areas which will be there as a part of the investment activities. While doing the investment cash flow, as I said earlier, the gross payments are very, very important. And a lot of times what happens is the net amounts are presented, or the loans given, or the loans which are given sometimes, and when they are repaid, only the net amounts are shown as an investment, or capital advances are not reduced from fixed assets. So those typical items get missed out, which needs to be taken care of in this area. Financing activities would be how the financing of the operations are happening. So it could be raising of funds from owners' capital, it could be bank borrowings, it could be loans from relatives, unsecured borrowings, a lot of other areas. The cost associated with raising these funds should be considered as a part of the financing activities. Item like increase in authorized capital should be reduced from financing activities and not shown as a part of the operating activity. So those type of adjustments do need to be made. One area where generally mistakes are there is the loans given, loan taken. They are shown as a net and not as gross. So their cash should be taken, so it should be shown at gross always. Interest payment should be the actual interest payment after considering the impact of the opening and the closing accruals, and not merely the figure which is debited to the P&L account. P&L account is the accrual figure, but in cash flow, we are looking at the actual cash payout on account of interest, or it could be royalty, or it could be any other such items. Foreign currency cash flow, there are two elements which should be taken care of. One is the unrealized exchange gain and loss. So for example, in debtors and creditors, there is a realignment which happens. So that realignment portion is an unrealized gain and loss, and that needs to be presented separately. In case there are balances which are held in foreign currency, it could be foreign currency bank account, EFC account, the movement in exchange rate in those foreign currency accounts, they are not cash flows or cash inflows or outflows. But in order to reconcile with the balance sheet, you need to show it separately. A separate line item may be required to disclose the movement from the opening cash balance to the closing cash balance. So there is a separate line item you will see in case of various companies where there are foreign currency bank accounts or foreign currency cash which is there. The exchange difference has to be shown separately to reconcile the opening and the closing cash balances. Non-cash transactions, obviously they cannot form part of the cash flows because they are non-cash. So properly they need to be eliminated from the cash flow statements. But there is a disclosure requirement that AS3 has, that such items should be disclosed elsewhere in the financial statements. So conversion of a debt into equity, acquisition of an enterprise by issue of shares. So those are certain transactions which will be excluded from the cash flow because they are non-cash, but there is a disclosure requirement which has to be there in the financial statement for non-cash items. So that care should be taken while preparing the financial statements, and appropriate disclosure for non-cash items also should be made. One typical area which I have found as a challenge is during the business purchase, when the acquisition of a subsidiary has happened and the merged financial statements are prepared, or when you bought over a company and the financial statements have to be prepared on a merged basis. the moment of debtors, moment of creditors or inventory, the whatever inventory, debtors or creditors you have acquired on acquisition, they have to be adjusted to bring about the proper movement in the cash flow, because that is an area where if that is not done, the proper reconciliation will not happen. Either the cash flow may not be tallied, or you will have an inconsistent presentation where either the acquisition payout is not properly reflected or the movement of the inventory is not correct. So that is an area where care has to be taken in terms where there are business combinations and acquisitions which are happening in a standalone level when the merger has happened or the acquisition has happened at the standalone level where the accounts are merged at the standalone level due to amalgamation, or at the consolidation level where consolidation accounts are prepared. There also sometimes if there are certain investments which are there where they are neither part of the subsidiaries or they are part of the joint ventures, you might have to take certain more care because they are proportionate consolidation would have happened and not full consolidation. So special care has to be taken on the joint ventures where there is a proportionate consolidation. At the time of disposal is another area where you have to take care, because the assets and liabilities which are part of the opening will have to be disposed. So how do you eliminate those at the time of the cash flow becomes very, very important, and a proper working note has to be prepared for those type of items. Taxes on income is another element in the cash flow which is there, and a lot of times what I have seen is that people do not either the opening moment of the opening and closing advance tax or opening and closing provision for tax is considered, but they do not reconcile with the actual cash payment. If you look at the total TDS and the advance tax figure, it does not reconcile. So that is sometimes an error which creeps in while doing the tax payment, tax payout. There are multiple elements which would have happened. There could be refunds which have come during the year. There would have been SA tax or any other taxes on at the time of completion of assessment which could have been paid. So it is not directly the number of provision for tax or the tax advance tax payment for the year. There could be transactions which are other than those which needs to be captured and factored in while this is there. And a lot of times the income is classified under different heads. So there could be investment which is classified under investment activities. Then the corresponding tax relating to that has to be shown under that head and not as a part of the operations. So if the income is segregated, the corresponding tax should also be segregated. That is the fundamental principle which is being highlighted by the accounting standard. Extraordinary items is very rare and generally it is not there, but the requirement is that you show it separately. Instead of extraordinary items, the concept which is now used is the exceptional items, something which we will look at it when we look at the other standards which are there, which are being covered separately. But if there are exceptional movements in cash flow which emanating out of the exceptional items, you need to disclose that separately so that it helps the reader in knowing that these are the cash inflows from an exceptional item and it is not recurring in nature, and next year you cannot consider that to be a normal routine feature. So that is how it is very, very important to understand some of these aspects and make those adjustments. There are certain disclosure requirements which are recommended and normally not very regularly seen. One is your amount of significant cash and cash balances held by enterprise that are not available for use. That is very important because there could be a lot of cash balance which are not available for use, and there has to be some commentary on that area. Amount of undrawn borrowing facilities that may be available for future operating activities or to settle capital commitments, indicating any restriction on use of those facilities. So if there are credit facilities which are available for future operating activities, you can disclose that. This will show the strength of the organization in terms of the undrawn facilities and what are the facilities are available in case there are certain contingencies in future, or the ability to pay out the liabilities can be more strongly demonstrated. aggregate amount of cash flows that represent increase in operating capacity separately from those cash inflows that are required to maintain operating capacity. So those are another recommended disclosure which is there. In this standard also there are multiple observations which are there from the QRV and the FRRV, something that we need to keep in mind while we finalize the cash flow statements. One of them is the fixed deposit held as margin money against bank guarantees, LCs. They are shown as a part of cash in bank balances or a cash equivalents. But what happens is that these are not convertible into cash and cash equivalent because there is an underlying lien on it, or it is related to an obligation which is pending to be completed, and hence they are normally not part of cash and cash equivalents. They have to be shown as other bank balances or other cash balances, and a reconciliation statement should be prepared in terms of what are the cash and bank balance as per the financial statements and what is cash and cash equivalent as per the cash flow statement. So that is one very critical area which is there. Capital advance is something which I spoke earlier, which is not reduced while looking at the cash outflow from the acquisition of fixed assets. Showing gain on redemption of mutual fund under cash flow from investment activities instead of showing the gross receipts on redemption of mutual fund. So this is on the crossing up of the investment activities, purchase and sale of investment to be shown on gross basis. Not reporting the effect of changes in exchange rate on cash and cash equivalent held in foreign currency as a part of the reconciliation of changes in cash and cash equivalent. This is something which we covered a couple of slides earlier, where the cash and cash reconciliation in case of foreign currency balances is something that needs to be provided. Not adjusting provision for doubtful debts being a non-cash item while computing the cash flow from operating activities. Amount of provision for tax was shown as cash flows from operating activities in the cash flows instead of taxes paid during the year. So this is another common error which is there, showing impact of capital advance and interest accrued on deposits under trade and other receivables instead of showing under cash flow from operating activities. So because normally there is a common schedule for other receivables or other payables, it needs to be properly segregated with a proper working note that these are not part of my operating and this will go as a part of my investment activity. Disclosure of cash flow in respect of CSR payment was not made. This is one of the requirement that the CSR payment should be shown separately as a part of the cash flow statements. This is one new requirement because of the guidance note of the institute which has come, that CSR payment should be shown separately in the cash flow statement. And errors in preparation of consolidated cash flow. This is one very challenging aspect which is there, because if you're looking at a consolidation of multiple entities, 60, 70 entities or very large corporates, the preparation of consolidated cash flow has a lot of challenges. One could be elimination of intercompany transactions, where there are a lot of transactions in terms of loans given, loans taken, investments made. Those eliminations are very challenging, and you need to have a proper working note and a control over all this intercompany transactions. The ideal method is to have the related party transactions with each entities in front of you, so that you know whether they are getting properly eliminated from the cash flow statements or not. So this is critical. It may sound a little easy or theoretical when I'm talking, but when you actually start doing it, a lot of questions do come out which are quite tricky in nature and which may require some scratching of your head to really give a proper or a right answer. Some of the tips on preparation of cash flow, which from my practical experiences are there, is that the three categories segregation, there should be proper clarity in our mind that what is operating, what is investing, and what is financing. The clarity on that should be very much there. Elimination of intra-group transactions during consolidated cash flow statement, exclusion of non-cash transactions, proper classification of interest received and paid into investment and financing activities, correct corresponding adjustment to be made among different category of cash flow statement, prepare working note file. So it is very important to have a working file. In most of the cases, the errors happen because it is direct Excel formulas which are there, or it is linked with the plus multiple items getting plus together without a proper working note. And without a proper working note, it becomes a major problem, and you cannot even audit it, or even in future if somebody has to trace what are the adjustments which are made to arrive at this cash flow statement, how it has happened. And in spite of we all understanding that there has to be a proper note, but in cases of hurry, sometimes there are shortcuts which are applied and it becomes a problem going forward. And one of the important thing is that we need to take a moment at the end of the cash flow to understand what is this cash flow talking to me, what is it telling me about the business, and whether my understanding which I have achieved through my audit over the last 1 week, 2 week, or 3 week, whether this cash flow also confirms my understanding or it is giving me a different signal. So that is something that we need to read, think. Either it will lead you to some error in preparation of cash flow, or it could lead you to something else in any other corresponding area. I don't know what, but having a look at the cash flow from that perspective will give you a completely different view, and obviously also take your level of knowledge one step higher when you are communicating with the owners of the business. So that is very important. This is on the cash flow which is there. I have tried to cover some of the practical issues which are there, requirements of the standard, and certain other issues which are there practically, which we have faced in terms of either consolidation or in terms of merger or in terms of acquisitions. We can go to the next standard which we have to cover, which is AS4. AS4 deals with contingencies and event occurring after balance sheet date. This is one of the earlier standards which are there, and after emergence of AS29, some part of this standard is not relevant because it is covered by AS29. And there are certain exclusions from the standard, which is liability of life and general insurance companies, obligations under retirement benefit plans because there is a separate standard, commitments arising from long-term lease contracts because again they will be covered by the separate standards, but it is not part of AS4. As I said earlier, only contingent losses with respect to assets are covered by AS4. The contingent liabilities provisions, they are dealt with by AS29 and not on AS4. So this is one very significant change, and with this change, lot of the part of AS4 is now excluded because it gets covered by AS29. So items like provision for warranty, they are now covered by AS29. One important question which always keeps on coming is provision for doubtful debt. There were one question was read, in which standard it is said that you have to make provision for doubtful debt. AS4 is a standard that needs to be referred to when you talk about provision for doubtful debt, because at a lot of times client asks a question that I am not wanting to make a provision, which standard will you qualify in? And sometimes the answer is not very apparent, not very obvious, and sometimes they're not at the top of the mind, so you may not be able to react or quickly, but you can look at AS4, that is the answer to this question. And also a lot of times if their qualifications are being made that debtors are not provided for, you will have to give reference to AS4 so that the drafting of the qualification is as per the auditing standard, because you have to talk about which accounting standard is not complied with. The definition of contingency is there, something which we understand that contingency is a condition or a situation where the outcome is not very clear. You don't know how it will get concluded. So today there is a debtor, he has an age which is more than 6 months, subsequently also unpaid, but management will say that payment will come in future. You are not certain. Sometimes management is also not certain. So these are the examples where the contingencies are part, or it could be insurance claim receivable. So those are areas, or there could be some more other examples, but those are typically the areas where the contingency standard will apply. On fixed assets, impairment will apply and not contingency. AS4 will not apply. AS28 will apply for fixed asset because impairment of asset is covered in that standard. The standard also says that you will also look at the events occurring after balance sheet date or reports of independent experts or what are the experiences of similar transactions when you want to make a judgment on the contingency and the impact of contingency and whether you make a provision or you do not make a provision for it. So you look at a past history of bad debts, or you may look at the past history of payments or the credit evaluation report from an expert. A lot of things may be looked at when you make this judgment. Ideally, it says that you should make provision for all contingent losses. Contingent gains are not accounted for unless it is extremely certain or virtually certain that it is a gain. And virtual certainty is something which is very, very difficult to ascertain or very, very easy, not an easy test to be met. So either it should have been already realized or very close to realization. In case you are not able to estimate the potential loss, you will have to disclose the fact and explain why you are not able to estimate or measure the contingency. This is very rare situation that you are not able to measure it, and generally the argument would be that you can make an estimate. Difficulty in making an estimate is not an excuse to say that I cannot make an estimate. You will definitely need to make estimate. The additional literature about all this, when you go to AS29, it talks about in great detail about various elements of liabilities when it should be provided, not provided. AS29 itself is a standard in itself and a subject by itself, but here we restrict to more of the contingent losses on the assets other than fixed assets which are there. Fixed assets or even inventories will get covered by AS2. In case there are counterclaims on third parties, you need to consider that while estimating the potential loss. So for example, if there is an NBFC company who has given a loss and there is a third party who has given a loan and there is a third party who is given a guarantee, then while estimating the loss or while making the provision, you obviously look at the potential recovery from the guarantor or the asset which is being there as a charge, and based on that you make the provisions. So those situations are permitted, and you have to make suitable disclosures about those aspects as well. Another part of this standard is on the events occurring after balance sheet date. This is something where the events occurring after balance sheet date are divided into two parts, adjusting and non-adjusting event. Do we understand this? But on an actual implementation, a lot of times questions do come which raise questions on whether it is event occurring or it's an adjusting event or a non-adjusting event. So those questions do come up on a practical level. There are certain challenges when you start to implement that. So one of the example of the adjusting event which is given is on the trade receivable part, where the party has gone bad, you are aware, then you obviously make a provision. Non-adjusting event, there are interesting questions which happens is that there are sometimes, especially on commodities or investment, there could be large fluctuation in values of investments. Whether after balance sheet date, if there is a large fluctuation in value of investment, do you still make a provision for it or you do not make a provision for it? So for example, if the stock market, if there is an investment which is there and the stock market has drastically fallen, should I make a provision in March or should I not make a provision in March? The standard says that ordinarily you should not do it, because those are events which have happened subsequent to the balance sheet and they were not existing as at the balance sheet date. So on a normal situation, you are not required to do it, or those questions do come up very frequently. And sometimes the mind gives a different answer that, the market has dropped so much, so why not make a conservative provision? But technically speaking, the standard does not really require you to do it in ordinary situation. If there is something which is out of ordinary, you may have to consider it, but on an ordinary situation, you are not required to do it. Dividend declared, few years back, there was a practice to make a provision for proposed dividend in the financial statement. But now it is very clear that you only put a note, you do not make a provision, because it is considered as a non-adjusting event, because earlier it was specifically considered to be an adjusting event. So this is a change which has happened from last 5-6 years. So something which we should be careful sometimes, because the old method are sometimes there in our mind and we can consider that only, but this is a change which we should be aware about and clear about. Sometimes there are unique situations that post year end there is something which has happened which really impacts the going concern. That is something that needs to be taken care while preparing the financial statements. So if there is a major fire, or there is a major earthquake, there is a war, or some other situation which is there which impacts the going concern, that has to be taken care. I have seen a situation where subsequent to the year end, management said that we want to close down the business. At that point of time, before the signing of the balance sheet, if there is a board resolution or the approvals which are there in place, you will have to consider those while preparing the financial statements, because then it is very difficult to prepare it on a going concern where the decision has already been taken to either shut down the business or cease the operations, or there are certain events which make it very difficult for you to say that accounts are on going concern basis. So this is one area where subsequent event review of board minutes, of any other important management minutes, or subsequent to the year-end trial balance is something which is very important. Just to share one more example, there is a process of subsequent event confirmation which is there, where the component auditors are required to mention to the group company auditors that there are no events occurring after balance sheet date which are adjusting events and which require adjustments. So this is a standard practice which is followed between the component auditor and the group auditor. And there was a situation which I have personally come across, where when we looked at the subsequent event, we did see that there was a realization from sale of certain government licenses, MEIS licenses, or which was there. Those were never shown as assets in the books of the company, and neither were it informed or discussed that we made an application to this, and obviously it was not realized by 31st March, so it was not there in the balance sheet also. But while looking at subsequent event, it was realized that there is a sale which is there is a cash flow which has happened, and then we had to immediately go back to the management and say, okay, why, if this has been sold, why was it not recognized as an asset on the balance sheet date? What are the uncertainties that were there for you to not to recognize this as an asset? And the other reporting to the group auditors also had to cover this area, and the appropriate changes had to be made. So a lot of times the events occur after balance sheet date. We cannot take it very lightly. The audit steps and the processes which are to be done by the auditors or even by the preparer of the financial statements, they will also have to take adequate care that if there is certain event which is there, which we realize that while looking at the financial statement, whether it should be considered or not considered in March. Another area where a lot of challenges are there in terms of the interpretation also is on amalgamation, because if the amalgamation is affected after balance sheet date, a lot of times the appointed date is of the earlier period, whether the effect should be given or should not be given if the order has been received subsequent to the year end. So the standard has this is part of the AS 14, which says that when an amalgamation is effected after the balance sheet date but before the issuance of the financial statement of either of the party to the amalgamation, disclosure should be made in accordance with AS 4, but amalgamation should not be incorporated in the financial statements. So this is one area where the confusions do happen, that it is effective from a retrospective date and the balance sheet is yet to be signed, whether I give the effect or do not give the effect, whether it is an adjusting event or not an adjusting event. So that position sometimes can be debated, but this is the guidance which is there from the standard, and there are certain expert advisory opinion also on this matter which are there, which needs to be looked at while this issue does come about. So hence this is something as a earmark issue that when you have such amalgamation matters, you need to be careful, because from a financial statement perspective, you may take a different position, and an income tax could require you to do something more differently, and hence it becomes even more critical. So these are some of the disclosure requirements, which I said is the nature of contingency, uncertainties which may affect future outcome, an estimate of the financial effect or a statement that such estimate cannot be made. If the dividends are declared after balance sheet date, but before financial statements are approved, that is we spoke about earlier, that disclosure has to be made in the notes. This is the part on AS4. The critical things which are there is that it is applicable to assets, not liabilities. Liabilities are covered by AS 29. Losses to be provided for, gains only on virtual certainty, adjusting event or non-adjusting event, and care to be taken for dividend, or in case of amalgamation where the orders are received subsequent to the year end, those are special care items, or subsequent to the year end there are certain events which are impacting going concern. So these are 5 or 6 critical elements out of the AS4 which are important and which needs to be kept in mind while we are finalizing the various audits. AS5 is the next standard which we have to cover, and it talks about various things in terms of, it is talking about prior period items, changing in accounting policies, changing in accounting estimates, extraordinary items, and ordinary items. They are broadly part of the AS5 scope. We should start with understanding of ordinary items, that activities which are part of the ordinary part of the business are ordinary items. Here values may not be very important, but the fact that whether it is a part of the normal business activity or not, okay, and that will define whether it is ordinary activity or an extraordinary activity. Incomes and expenses arising out of events that are clearly distinct from normal business operations are extraordinary items. Very, very rare to see somebody has given a disclosure of extraordinary items. Earthquake is the example which is given in the standard, that it is an extraordinary event loss, but there also is a subject matter of debate that if you are living in an area which is earthquake prone, whether it is part of an extraordinary event or not an extraordinary event is a subject matter of debate. There are articles, or in the US there was a question when the 26 when there was this World Trade Center blast, whether that event is an extraordinary item or not, the losses arising out of that, and the answer which was there from the regulator is that they are not extraordinary items and they are ordinary business items. That was the item. There is a newspaper article also available on that area. So it is very, very rare that there will be something which is called an extraordinary item, and we need to be very, very careful before the classification happens as an extraordinary item. So that is one area where a lot of care should be taken. Prior period items, another very, very critical part while the financial statements are prepared or audited. Errors and omissions are something which is there, because of which there are prior period items. And when there are prior period items, their proper presentation, disclosure, so that their impact on the profit of the current year is clearly demonstrated, is something that is required to be done. Changes in accounting estimates and changes in accounting policies. These are areas where a lot of times there is a confusion, or there is a question which comes whether it is a change in estimate or a change in policy. So there clarity should be there. Changes in accounting estimate are revisions which are made due to changes in circumstances based on which the estimates were made. So you may have a provisioning policy which was there earlier. If it is changed, it is a change in accounting estimate. Change in accounting policy is change in a policy which is there, and which is a larger umbrella item. An accounting policy estimate is something which is one below it. Net profit or loss for the period. All the items of income and expenses are recognized in the period should be included in determining the profit and loss. So even if it is prior period or extraordinary or current period, they have to be part of the profit and loss. Though prior period or extraordinary, you will show it separately. And as I said earlier, extraordinary is something which is very, very rare and not a day-to-day activity. But there are items which could be exceptional in nature. Though this word exceptional is not defined anywhere in the standard, but the standard does have a paragraph which says that though they are part of the ordinary activities, the size and nature is such that they need to be shown separately so that people can understand the financial statements more clearly. So for example, disposal of long-term investments, legislation changes with retrospective application. One of the example was in between there was this provident fund related judgment from Supreme Court which says that certain emoluments need to be considered while deciding the provident fund amount. A lot of entities had to make a lot of provision because it was a retrospective judgment, God knows from which financial year. And hence, if you are doing something of that sort and if it has a large effect on the financial statements, it will have a retrospective application. The new labor code which is expected to come, where they are saying the basic salary should be minimum percentage, and if the basic salary which is currently there, if it is not of that range, there could be an impact on the retirement benefits and the other items which are there. And those items, if they are very large and retrospective, you may consider those part to be retrospective legislative changes, and you may consider those part to be exceptional. Litigation settlements are another items which are seen, which are part of the exceptional nature. So if there is a large litigation which is there and settled during the year, because it is a non-recurring event, one-time event and very large in nature, you may consider that to be a exceptional item. Recurring restructuring of activities on account of acquisition, if certain extra cost is there, or divestment related expenses which are there, or any other such restructuring which is there, those are sometimes considered to be exceptional in nature because they are not regular items. But again, lot of care has to be taken when you talk about exception, not talk about exception items. Proper notes and disclosure should be given, and the consistency year on year in terms of application, classification should be maintained, and it should not be a convenience based approach. Prior period items are something which we all understand, errors and omissions, whether they are disclosed properly or not. A lot of times the client resistance is highest when you talk about prior period items, because obviously there are income tax implications also, and there are implications on the quality of the results and the quality of the audit which was performed in the earlier period. And hence a lot of care has to be taken while finalizing the accounts that all suitable expenses are fully provided for, and it does not normmally occur. One area where people miss out on prior period items is something called as a past service cost, which is there when you look at the AS 15 calculations from the actuary which comes out, and there are items like past service costs which are there. Further inquiry needs to be made in terms of why it is there, and if it is due to an error of earlier period, then that is a prior period item. And prior period items should be distinguished from changes in accounting estimates, because changes in accounting estimates are not prior period items. So if there are management judgments which are changed because of the changed circumstances, they are not prior period error, because hindsight is not required to be used at that point in time. But if the judgment was erroneous and it was not correctly done, there could be a debate on whether it is a prior period item or not a prior period item. And the changes in this estimates become more and more complex when you look at especially a real estate industry, where the total saleable area of a project is dependent upon the number of tenants which are vacated, SRA approvals, or the government regulations as regards the permissions in terms of what is the ratio of development which is permissible. And if those estimates change, the profitability which is recognized, the project profitability, the revenue recognition, lot of things changes, and hence the impact of such changes, they need to be disclosed very clearly in the financial statements that there were certain changes and these are the accounting impacts, as a result of which either profit for the year is higher or profit for the year is lower, because the past year's impact has been there during the financial statements of the current year. So that changes in accounting estimate, because what happens is that there could be a question that was the accounting estimate correctly done or there was an error in that, and there will be a very thin line of judgment in those areas. Further elaborating on the changes in accounting estimates, as I said earlier, that there will be a lot of times when you change the provisioning norms, or inventory provisioning norms are also changed for slow moving items, non moving items, or defined benefit obligations. So for example, salary obligation, increase in the increment rate is changed from 6% to 8%. That is a change in estimate. Or mortality rate, or the rate of resignation, or the attrition rate, if that is changed. Those are typical changes in estimates which are there. Change in useful life of a fixed asset is a change in estimate, and not a change in policy. One point which is again important, that whenever there is a change in the estimate, there is a need for a disclosure as regard the changes in estimates and its impact. And if the impact is not quantifiable, you mention the reason for it and the fact has to be disclosed. This is one requirement of changes in accounting estimate which is sometimes not complied with, because either it is something not very apparent, or while we finalize in a hurry, other things may be more important and this aspect sometimes get missed out. But from a comparability point of view of the financial statements, the disclosure about the accounting estimates, their changes becomes very, very important. As we move towards Ind AS standards, the accounting estimates and their judgment plays even a significantly greater role and have a greater disclosure requirements in those standards. So this is what I was talking about when I said in the earlier side that change in accounting estimate should be part of determination of profit and loss account for the period, or if it is going to impact for the future period, then both. But your notes should be very, very clear that the accounting estimates impact the current year, or as well as going forward it will have an impact. Another example which I can give is that if there are changes in provisioning norms for NBFC companies or banks, this impact of this changing in norms are part of the changes in accounting estimates. Either it could be regulatory or either voluntarily which is done. And to have that sharpness, that if there are certain changes which have happened as compared to last year, those have to be disclosed properly so that the quality of the accounts and the disclosures are of the highest level. Changes in accounting policies and changing in accounting estimates. There is sometimes a confusion between those areas. Just to clarify, changes in estimate relating to depreciation, bad debt allowance, they are accounting estimate changes. Changes in revenue recognition policy or inventory valuation policy is a change in accounting policy. So you have to be clear whether it is a policy change or an estimate change. Estimate is one step lower than a policy because you are implementing while implementing in a policy, you make estimates. Policy is one level above an estimate. If you have a hierarchy, some of the examples which are again there is the adoption of a new accounting policy, which was there. New accounting policy or transactions which did not occur previously are not changes in accounting policies. They are new policies which are adopted, but they are not changed. Changes in valuation method of inventory is a change in accounting policy. Change in depreciation is a change in accounting estimate. If there are changes in the retirement benefit plans, they are not a change in accounting policy. So distinction between accounting policy and the accounting estimate needs to be very clearly understood. We all understand that part of it, but a frequent revision on some of these areas just help us to refresh some of the old things which are there. Changes in accounting policy should be done only if it is required by the statute or for compliance with a newly introduced accounting standard, or if it is considered that the change would result in a more appropriate presentation of financial statement. Now this we all understand, but while changing an accounting policy, we need to look at these factors very closely. Why is this change happening? Why are we changing from WDV? Why are we changing from FIFO to weighted average? Is my business changing? Has the nature of products changed? Is the environment changing? Why am I changing this? What are the tax implications of this change, or any other implications which are there? So that justification which is there, that should be very clearly understood, thought out before you venture into changing any accounting policy. It is not a convenience-based approach. These are items which are rare, which should ideally be avoided, because consistency is a fundamental assumption of any accounting financial statement. There has to be a proper disclosure of any change in accounting policy, the impact adjustments resulting in that. Would the profit be higher? Would the profit be lower? As far as possible, the estimate of the change should be made, and we should not try to say that it cannot be determined or the impact cannot be quantified. Only in very rare scenarios we should use that statement. If the accounting policy change has no material effect on the financial statement for the current period, but is expected to have material effect in the later period, such fact should be disclosed. Some of the considerations which I mentioned when I was talking in the earlier slide as regards adoption of an accounting policy, which are not accounting policy changes, because if there are new transactions, they are not accounting policy changes, which we spoke about already. Disclosure has to be given even if there is a new accounting policy which is there by management's own decision or introduction of new accounting standard. And whenever a new accounting standard is introduced, the transitional provisions of that accounting standard should be kept in mind, because there will be certain transition provisions which are there, and if you are applying those transition provisions, those disclosures are also required to be made if there is a newly accounting standard which is there. So when the property plant equipment standard, which was introduced a few years back, which is similar to the Ind AS standard, there were certain transition requirements which are there. If there are certain changes, you could have avoided certain things. So those disclosures had to be made. Many years back when AS 22 was introduced, there was a transition which was available where the impact could have been made in the reserves. So those, if transition benefits are availed, those have to be also disclosed when you disclose the entire bucket of the transaction. So this is the broad coverage on the various accounting standards which are there. These were the 4 very basic accounting standards which we are using on a day-to-day basis at various forums, at various entities across. Be it even if you go to the Ind AS standard, some of these basic principles would not change. Maybe it dwells further into some of these areas and goes into further more detailing with more disclosures, but these are very, very fundamental or to the entire preparation of the financial statements. Now we can have the question answers on some of the areas which we have covered.
मिश्रा सर, कोई क्वेश्चंस है क्या? मिश्रा सर,
हाँ मैडम,
क्वेश्चंस आए हैं क्या?
एक ही क्वेश्चन है मैडम, ये 2 मिनट में दे
हाँ, तो-
आपको चैट में दे रहा हूँ मैडम, आपको चैट में दे देता हूँ। देखिए मैडम, चैट में दिया आपको, एक ही क्वेश्चन है। चैट में दिखा मैडम आपको?
Yes sir, yes sir, yes sir. So the question is, what format is to be used by category 2 AIF funds and no format is given by SEBI?
So no format is given by SEBI, I understand. So the new guidance which is there, that can be applied to the extent available.
So that's all for the questions from the audience side. So if you want to take something else, you can cover it, or then we can wind up the session.
Something else.
Or else we can wind up the session.
Yeah, on this, because something else, because on this we have exhaustively covered and we already gone up to 2 hours, more than 2 hours. So if there are any other specific questions, if there are any other interaction which is required, I think that could be useful. I think that would be more helpful.
Yeah, so I request the participants.
Repetitions, if there are, yeah, we can have any other questions which people want.
Yeah, so I request participants, if there are any more questions, you can write to us. So sir is willing to solve that. So we'll wait for a few minutes if there is any questions.
Yes, yeah. But generally, what I have also observed, one challenge which is there when we finalize the statements in a hurry is that there are a lot of copy paste errors which happen, especially in the accounting policies. So that is something which is which can be avoided. That is one area which can be avoided, because usually the last year's accounting policies are pasted in new transactions, either if there are any or changes which are required, or there are new standards which are coming in. Those gets ideally missed out, and hence that slightly more care on those areas can be there. That is one more tip which I had, which I can share with the participants, because a regular nuisance sometimes is there that copy paste errors keep on happening, and then after some time we realize that, oh, we made this mistake. So that is something where more care can be taken.
So I think there are no more questions coming up. So we can wind up the session.
Sure.
So on behalf of WIRC, I extend a hearty vote of thanks to you, sir. You have covered all the aspects very in lucid manner. If some amateur has joined this program, then too he would be now the king of accounting standard. And thank you, sir, for giving your valuable inputs, your ideas, your knowledge in the presentation, and your and also agreed to be a speaker in our refresher course. Thank you so much, sir.
Thank you all.
Thank you. Mishra sir, we can end the session. We have sir, we have one question if you want.
Yes.
The question is, do you think that the accounting standards will be converged with Ind AS in the years to come, or it will be a dual regime always?
Long-term plan of the institute, if my understanding is correct, to converge to the Ind AS standards slowly and steadily, with some exemptions to the smaller companies. So that seems to be the longer plan. So if you see the accounting standards which are currently there, AS2, AS3 are very similar to the Ind AS standard with very small variations. AS29 is also very much in line with what is there in the Ind AS, with few variations they are there, almost 90% similar. AS15 is another standard which is more or less similar to the Ind AS standard. AS10 is similar to the Ind AS standard. So there are many standards which are already very close to the Ind AS standards. Related party transaction also has very few differentiations. So the long-term plan would be that slowly and steadily some of the standards will get upgraded. So it may not be 100% to the Ind AS or the IFRS level, but 80 to 90% level it will slowly and steadily go. one area which I am not very sure about right now is what are they doing about the financial instruments, which is one of the large standards in the Ind AS area. Whether something corresponding to that may come in IGAP or not is something which I am not very sure about. But the other standards will definitely move closer to the IFRS or the Ind AS level.
Thank you, sir. Thank you so much, sir, for clearing the doubt. Thank you so much.
Thank you.
सर एक क्वेश्चन और है सर.
हाँ बोलिए ना.
The question is, how do we ensure that owners of the organization give importance to accounting standards? It seems that they are generally ignored.
This is a very valid question, and the only way we are able to bring about this is by frequent interaction with the owners, where the impact of this, if we are able to explain that the accounting standards are not merely having an impact, either it has an impact on their taxation or the way the business is happening, there is a certain impact on that, then they will start taking interest, or how they impact their financial statements. So for example, I will tell you 2 or 3 examples which I can share on this. Is that a company which had very recently issued NCDs, and one of the condition was that after 12 months the NCD holders have an option to redeem the NCDs. Now they were classifying these NCDs as current and non-current. Now, since the NCD holders have an option to redeem, that was something the accounting standards between current and non-current classification requires that it should be current. Now, when you shift the significant portion of the non-current to a current, what happens is the impact which it will have on the business in terms of the banking ratios, in terms of the other disclosures, it will automatically, from a business side, somebody will realize that when they are structuring this document, they need to look at accounting standard compliance. Another example is on the AS 9 on the revenue recognition front, where the contracts which are getting entered, what implication it has on the revenue recognition. People will have to bring about the contracts, they have to structure in a manner where the impact is of the accounting standard on the accounting will have to be considered, or be it a business combination. What happens if there is a large goodwill which is created, and the goodwill which has multiple implications either in terms of impairment or in terms of the tax implications, because it may not be an allowable item under income tax considering the changes in laws which have happened recently. So if those items are presented to the management in the right manner, they will start realizing the impact and the incidence of this, and due impact will be given. But I understand the question is very, very correct, that it is a slow process, but only frequent interaction with the management is the method in which you will be able to convince them that these are the changes which are happening and this is the impact and this is the value addition that we as chartered accountants or as auditors are bringing on table. Unless we highlight those to the senior management at a frequent interval, it will never happen. And one of the mistakes that we do, and including myself also, that sometimes in a hurry we just finish completing the financial statements and we may have discussed everything with the accountants or the CFO, but we do not meet the promoters with them for even 15 minutes, 20 minutes to highlight that these were major accounting decisions that we had to take and these are the implications of those, or these are the issues which we encountered. Unless frequently we are highlighting those things to the senior management, they will not realize the importance. That has been my personal experience for last 15 years.
So the next question is, can you please again explain the treatment of business purchase in cash flow statement?
Yeah. So what happens is that if you have purchased a business, so along with the business, the inventories and everything will be purchased. While preparing the cash flow, you need to do 2 things. One is that the amount which you have spent for purchase of the business has to be shown separately. So that is the gross amount which you have paid. When you have paid the gross amount, what you did receive is you received inventories, you received liabilities, you received debtors. So when you have to show the gross amount you spent, and the adjustments which have happened, because when you look at the opening, assume the opening inventory was 0 and you acquired a business, and upon acquisition of the business you got rupees 20 of inventory. So the opening inventory is 0, closing inventory is 20. So does it mean that the 20 is an outflow because of the acquisition of inventory? No. 20 is not the outflow because of acquisition of industry. 20 is the outflow for purchase of business. So once you do the gross up, you will have to make a corresponding adjustment in the inventory to bring about that. In inventory, actually there is no cash flow. The cash flow was for purchase of business, which is a investment activity and not an operating activity. So from the closing inventory, you need to reduce 20. So it will come back to 0. So opening 0, closing 0, there is no change in inventory. The corresponding 20 will be the cost of acquisition of business. Similarly, for other items also, we'll have to do it. I mean, verbally, I may be able to explain it this manner, but if it was a physical session, I could have drawn an example and shown this.
The
Because
next
this is
question
an
is,
area where a lot of errors happen in cash flow.
okay, so can we move to the next question?
Yes, yes, please. Unless the person has a repeat follow-up question.
In case of accounting standard 15, no valuation from a actuarial is required for company having less than 50 employees. So if management decides not to undertake valuation, then how it will impact the audit reporting?
If that exemption is available, then you make it has to be disclosed as a part of the accounting policy that is exemption is available considering the size of the items, and the valuation report is not there. And in absence of valuation report, what it has done, either it has followed an arithmetical approach, or at least arithmetically it would have to be done. So even if arithmetical valuation is not done, then you have a problem. Then either it will lead to an audit qualification, because it does not say that you need not provide for liability. You do not do actual valuation, because actual valuation has a cost and it has method estimation, it requires efforts. So that is the exemption which has been given. So if the actual valuation is not done, you do the arithmetical calculation, make a suitable disclosure in the accounting policy and in the notes. And arithmetical is typically very simple. So if there are 50 employees, you make an Excel sheet with the employees, their basic salary, number of years of service, and you do the calculation for their gratuity liability. So that is a simple arithmetical calculation. That is the bare minimum which needs to be done.
Okay, sir. So अभी कोई question है क्या मिश्रा sir?
नहीं मैडम, नहीं है. Thank you.
So that's all from the question side from the participants. Thank you, sir, for giving your valuable time and clearing the doubts in the minds of. Thank you so much.
Thank you. Help. Great.